Gold isn't deciding anything this week. Someone is being forced, and the price action is the cover story. You can feel it in how violent the tape has been, and you can see it in the way gold punched into record territory above 5,000, even tagging the $5 to $300 zone in late January. Not because the world suddenly discovered gold, not because a single headline changed everything, but because the market's plumbing is tightening. And when the plumbing tightens, price becomes a weapon. And here's the payoff you're going to get by the end of this. You'll have a clean, near-term roadmap for the next 1 to 2 weeks. What level matters, what confirms the breakout, what turns it into a trap, and the exact behavior that tells you when the next shock is about to hit. Right now, everyone is staring at the obvious thing, the price. It's loud, it's emotional, it's the only number most people can see. But the hidden detail, the one that reframes this entire story, isn't the price, it's time. It's how gold is being priced across different delivery windows, and what that reveals about stress, funding, and forced behavior under the surface. And that's where the real pressure starts. Because let's ground this in what just happened. At the start of January, gold was in the low 4,000s. Within weeks, it had ripped higher in a way that doesn't feel like a normal bull market grind. It feels like a regime shift. It feels like liquidity thinning out stops getting hit, dealers stepping back, and the market lurching upward in gaps. By the last week of the month, you had spot prices pushing through $5,000 and then accelerating, with major outlets reporting prints above $5,200 and even above $5,300 around January 28th. That kind of move compresses time. It pulls future demand into the present. It forces decisions. And it punishes anyone who shows up late with leverage, but that's not the part that matters. The part that matters is what happens after a vertical move when the market reaches a round number gravity point, $5,000 is one of those, and then approaches a fresh discovery zone, like $5,300, where there's no comfortable memory of prior trading. In that zone, the market stops behaving like a debate and starts behaving like a machine. If you're a retail investor, you feel that as confusion. If you're a fund manager, you feel that as risk limits. If you're a dealer, you feel that as hedging math. If you're an industrial buyer or a physical allocator, you feel it as availability, premiums, and timing. Same price. Completely different incentives. And that's why this week can either be a clean breakout that becomes a new floor, or a nasty breakdown that looks like the end of the world, but is really just the market resetting leverage. Because if this one level breaks, the math changes. So let's talk about the two armies on the field, because understanding their incentives is half the game. On one side, you have breakout buyers. Some of them are true believers, macro hedgers, reserve reallocators, long-term allocators who see gold as insurance, but a lot of them are not. A lot of them are trend followers, systematic funds, momentum chasers, and late retail who only woke up because price forced them to. They buy strength. They buy confirmation. They buy, it's working. All right? And they tend to use stops, which means their conviction is not as strong as their position size. On the other side, you have breakdown sellers and mean reversion traders. Some are shorting because they think the move is absurd. Some are shorting because volatility is rich. Some are shorting because they're hedging physical exposure or mining exposure. Some are shorting because they believe the dollar will snap back and crush the metal. Whatever their reason, their bet is the same. Price went too far too fast, and gravity will return. The problem is this: when a market is being driven by forced behavior, gravity takes a holiday, and that's where people get hurt. Now, if you want to know whether this is breakout or breakdown, you don't start by asking, is gold expensive? That question is how you lose money in a bull market. You start by asking, what is the market forcing participants to do right now? Because markets don't move because they're cheap. Markets move because someone has to. And the hidden detail tells you who has to. Here's the hidden detail in plain English. Gold is not just one price. It's a chain of prices across time. Spot, front month futures, later month futures, forward rates, swaps. In normal conditions, gold futures typically trade in a gentle upward slope, contango, because there's a cost to carry: financing, storage, insurance. That's the default. When that curve changes shape, when the near term gets unusually strong, or the spreads behave oddly, that can be a sign that funding is stressed, that the desire for immediacy is rising, or that hedging flows are distorting the surface. And the reason this matters this week is simple. Month end is when balance sheets, hedges, and risk budgets get audited by reality. The calendar isn't a background detail. The calendar is the catalyst. The next detail is what flips the whole setup. Because month end does two things at once. First, it changes liquidity. Real money rebalances. Some funds lock in gains. Some funds reset exposures. Dealers get less willing to warehouse risk into thin conditions. Second, month end tightens risk management. If you're up big, you're tempted to de-risk. If you're down big, you're forced to de-risk. Either way, leverage comes off. And when leverage comes off in a market that just went vertical, the pullbacks can be savage, even if the bigger trend remains bullish. So if you're looking for gold breakout or breakdown this week, the honest answer is the trend can be up and the tape can still punch you in the face. That's normal. That's the game. And it's exactly why the audience that survives is the one that watches mechanisms, not narratives. Let's stack the proof the way a skeptical macro watcher would, layer by layer, not with one fragile story. You've seen a global pattern over the last several years of central banks accumulating gold at a pace that has surprised people. World Gold Council data showed central bank buying above 1,000 tons in 2024, and the broader theme has been persistent accumulation. The important part isn't the exact number. The important part is the incentive. Reserve managers diversify away from dollar concentration and away from assets that can be frozen, politicized, or devalued by policy choices. That creates a structural bid that doesn't care about your RSI. It doesn't care about your trend line. It cares about strategic allocation. Meanwhile, ETFs and ETPs behave differently. They can surge on fear and then reverse on calm. They're faster money. They amplify moves both directions. So in an environment like this, you can have slow structural buying underneath, while fast flows whip the tape on top. And that's why you can get both breakout and breakdown energy in the same week. That's not a contradiction. That's the market. Layer 4 is market structure. When gold makes fresh highs into round numbers, the options market can become a feedback loop. You don't need to be an options nerd to understand the basic reflexivity. If there's a heavy concentration of calls around big strikes, $5,000, $5,200, $5,300, dealers who sold those calls may need to hedge as price approaches. In some setups, that hedging becomes buying into strength, which pushes price higher, which forces more hedging. It's not magic, it's math. And in thin liquidity, math looks like momentum. That's one way you get a continuation squeeze that feels like the market has lost its mind. But if price stalls and rolls over, the same reflexivity can unwind. Hedgers sell as delta falls. Momentum funds flip. Stops cascade. That's why this week is dangerous for anyone trading without a plan. Because if the feedback loop flips, it flips fast. Layer 5 is the physical versus paper tension. No, you don't have to go full conspiracy. You just have to respect incentives and constraints. Futures are leveraged and liquid. Physical is not. Physical has lead times, logistics, refining bottlenecks, and regional premiums. When physical demand rises, whether from retail, sovereigns, or industrial allocation, you'll often see symptoms. Tighter availability, wider premiums, stronger nearby contracts, unusual spread behavior. And even if you don't have perfect visibility, you can watch the proxies. That's what pros do. They watch the behavior that forces other participants to act. Now, let's translate all of this into the only thing that matters for you, what happens next and what to watch. But first, we have to define the battlefield in a way that doesn't rely on fantasy precision. In a move this extreme, levels are zones, not laser lines. A market that can jump $100 or $200 in a day doesn't respect your exact number, so think in bands. Because the first pullback after a shock move is where the market reveals who the real buyer is. If the pullback is controlled, tight candles, shallow retrace, quick dip buying, and most importantly, strong closes, it suggests real money is supporting price. If the pullback is chaotic, wide ranges, failed bounces, heavy selling into rallies, it suggests leverage is unwinding and the move was more fragile than it looked. That's how you separate breakout with retest from breakout trap. So here are the two scenarios you need this week. Scenario 1 is the controlled pullback and retest. In that scenario, gold may dip. Maybe it retests near $5,000, maybe it wicks into the high 4,900s. It drives leverage, and it ends with one of two outcomes. Either the squeeze continues longer than anyone thinks possible, or it ends in a violent air pocket that erases days of gains and hours. If you're going to survive this scenario, you need rules. You need to treat it like a volatility regime, not a normal market. Now, I said the hidden detail was time, and we need to make it real. Here's what I want you listening for this week. Any sign that the near term is unusually bid relative to later delivery, or that spreads are acting like there's a premium on immediacy. Normally, gold's curve reflects carry costs. When stress shows up, the curve can flatten, invert in certain pockets, or behave in a way that suggests funding and delivery incentives are shifting. You don't have to stare at a complex matrix. You just have to notice when the front month is acting like it's being pulled by a different set of hands than the back month. That's the spread telling the truth, even when headlines are screaming something else. And that's why the market can shock you, because the real signal is somewhere else. Another piece of the hidden detail is the relationship between price and participation. In many blow-off moves, price rises while participation quality deteriorates. You can sometimes infer that through behavior. Explosive days followed by immediate dead air, huge wicks, sudden volatility expansions, and a sense that the market is being pushed rather than built. If you see price go up, but it feels like fewer and fewer participants are comfortable holding it, that's when the risk of an air pocket rises. Conversely, if price goes up and then starts trading normally again, tighter ranges, orderly dips, measured advances, that's healthier. It's counterintuitive, but the strongest bull markets often feel boring after the breakout. If it feels like a nonstop adrenaline rush, that's often late cycle behavior. But that's not always bearish. It just changes how you manage risk. And let's talk about risk like adults, because credibility matters. Price can whip around violently even if the thesis is correct. That's not a disclaimer. That's the core reality of leveraged markets. Gold can be in a structural bull regime and still drop hundreds of dollars in a liquidation pulse. If you confuse that pulse with the end of the story, you'll sell the bottom and then watch it rip without you. If you confuse every rip with safety, you'll buy the top and then panic out in the first flush. The market's favorite hobby is humiliating people who don't have time horizons. So decide your horizon. Are you trading the next 2 weeks? Are you allocating for the next 2 years? Those are different games. Use different tools. Use different position sizing. That's how you keep your sanity. Now, let's connect this to the macro regime, because gold doesn't go parabolic in a vacuum. A big driver here is the idea that the safe asset landscape is changing. If investors are questioning the reliability of bonds as a hedge or the predictability of policy, gold becomes the cleanest liquid alternative. When the dollar wobbles and real yields become uncertain, gold gets a bid. When geopolitical risk rises and sanctions risk enters the conversation, gold gets a bid. When fiscal deficits expand and the market starts to price a long-run debasement path, even if inflation prints are mixed, gold gets a bid. And as you've seen in recent years, central banks have been willing to buy gold even when retail sentiment is skeptical. That matters because it changes the floor under demand. But it doesn't eliminate volatility. It just means the dips can be violent and still get bought. So what could flip the script into a breakdown this week? Let's be honest about the counterpoints, because that is how you build trust with a skeptical crowd. Counterpoint 1, the dollar can bounce hard. If the dollar's sell-off has been exaggerated, crowded, or driven by a narrative that gets challenged, you can get a reflexive rebound. That rebound can hit gold like a hammer in the short term. Counterpoint 2, profit taking into month end can be brutal. After a move like this, anyone sitting on gains has an incentive to lock them. Counterpoint 3, if rates expectations shift, if the market suddenly prices less easing, or if policy rhetoric turns hawkish, gold can react negatively even if the long-run story remains. Counterpoint 4, if equity markets stabilize and volatility drops, some fast money rotates out of gold. Counterpoint 5, positioning. If too many people are leaning the same way with leverage, the market will eventually punish them, even if they're right. Those are real risks. None of them require the world to become safe. They just require a change in marginal incentives. And the marginal buyer is who moves price. So here's the breakdown path in a clean sequence, because if it happens, you want to recognize it early, not after the damage. First, you get a failure to hold above a key shelf, often the round number or the breakout zone. Second, bounces become weaker. You start seeing rallies sold quickly. Third, volatility expands on red candles, not green, and that's important. Fourth, a level breaks and stays broken on a daily close and the market stops snapping back. Fifth, the narrative shifts from dip buy to get me out, and that's when margin pressure appears. Margin pressure is the accelerant. It forces selling regardless of thesis. It creates air pockets. And because gold is liquid, it becomes the thing people sell to meet calls elsewhere. That's how you can get an ugly flush, even in a bull regime. If you see that sequence, you don't argue with it. You respect it. Because the tape is telling you leverage is being cleaned out. And that's where the real pressure starts. Now, the breakout path is almost the opposite. First, pullbacks are bought quickly. Second, the market forms higher lows. Third, daily closes remain strong even if intraday volatility is wild. Fourth, the market begins to consolidate near the highs, tightening ranges, building a shelf. Fifth, you see the market stop reacting negatively to scary headlines. That's a big one. When bad news stops pushing price down, it means the market has absorbed it and demand is dominant. Sixth, the next push higher often happens in a thin window, late week, around month end, into a weekend gap. That's when the market uses time against you. It makes you chase when you don't want to hold risk, and it makes you sell when you do. If you see those signs, you treat the trend with respect. You manage risk, but you don't fight a tape that S being supported by structural flows and reflexive hedging. Now I'm going to give you a simple checklist for this week, not to predict, to observe. Because observation beats prediction in a market like this. First, watch the $5,000 shelf as a psychological anchor. If price is above it, ask, does it hold on closes? If price dips below it, ask, does it reclaim quickly or does it churn underneath? Second, watch the reaction to the $50,200 or $50,300 record zone area. If price is currently around there, do you see consolidation or rejection? Third, watch the dollar's reaction function. Does the dollar weakness continue or does it snap back? A snapback doesn't end the gold story, but it changes the near-term tape. Fourth, watch volatility. Are the big days happening on the upside or downside? Fifth, watch the speed of dips. Are dips being bought in minutes or are they being sold for hours? That tells you who is in control. Sixth, watch the calendar. Month-end flows can distort everything. A Thursday or Friday move into month-end can be less about new information and more about positioning reality. And that's why this week can shock people who think markets are purely rational. Let's also talk about the psychology shield, because if you don't protect your head, the market will own you. After a vertical move, the market weaponizes volatility in two ways. One, it creates FOMO, fear of missing out, by showing you strength without giving you a clean entry. That pushes you to chase at the worst moment. Two, it creates panic by ripping the floor out in a sudden flush, making you feel like the world is ending. That pushes you to sell at the worst moment. Both are the same manipulation. It's the market using tempo to hijack your decisions. Your defense is simple. Decide in advance what would change your mind. Decide your time horizon. Size your position so you can survive normal volatility. And treat pullbacks differently depending on whether they are noise or trend damage. Noise is a scary candle that gets reclaimed. Trend damage is a level that breaks and stays broken with weak bounces. If you can't tell the difference, you'll react to everything. And reacting to everything is how you bleed out. Now, let's make the payoff concrete. Targets, invalidation, and next week expectations, without pretending we can forecast every tick. In a market this wild, targets are zones and they depend on scenario. If the breakout scenario plays, the market can absolutely press beyond the $5,300 area and look for the next psychologically magnetic zones. $5,500 becomes an obvious one because round numbers attract positioning and option strikes. That doesn't mean it goes there in a straight line. It means that's where the next battleground could form if the tape remains supported. If the controlled retest scenario plays, you could see the market cycle between $5,000 and the record zone, building a base before the next leg. That's healthy. It would frustrate people who want fireworks, but it's what sustainable trends look like. What would weaken the bullish setup in the near term? A failure to hold the $5,000 shelf on a closing basis combined with weak rebounds, not one dip, not one scary wick. I mean a behavioral shift. Dips stop being bought, rallies get sold, and the market starts living below the level it just conquered. That's when the move turns from breakout into trap. What would invalidate the immediate breakout narrative? A decisive breakdown that drags price back into the prior range and keeps it there, making the record zone look like a blow-off. If that happens, the next question becomes, is it just a leverage flush that sets up a better long entry later, or is it a genuine regime change? You answer that with behavior, not with emotion. And what about the market shock incoming part of the title? What's the shock mechanism? The shock is not necessarily a single news event. The shock can be structural. It can be a weekend gap where liquidity is thin and positioning is wrong. It can be a month-end rebalance where someone has to buy or sell size in a tight window. It can be an options-related squeeze where hedging accelerates the move. It can be a funding or spread dislocation that forces participants to scramble. In other words, the shock can be the market realizing it mispriced risk. And that realization often happens when time is short. That's why the calendar matters this week. One more thing before we close, because the metals crowd understands this instinctively but sometimes forgets it in the heat. Gold is not a meme. It's a balance sheet asset. It's a reserve asset. It's an insurance policy against institutional drift. But the market trades it like a leveraged instrument. Both can be true. That's why the people who win in this space don't just believe in gold. They respect the plumbing. They respect spreads, positioning, and liquidity. They respect that a bull market can still hurt you if you size it wrong. They respect that volatility is a feature, not a bug. So here's how I want you to think about the next week or two in one clean mental model. If we get a pullback, the question is not, is it scary? The question is it controlled and does it get reclaimed? If yes, that's the market building a floor. If no, if levels break and rebounds fail, that's leverage unwinding, and you stand down until the tape stabilizes. If we don't get a pullback, if it keeps squeezing, then you treat it like a volatility regime. Don't chase with size you can't hold through a gap, and don't let FOMO write your trade plan for you. That's how you avoid becoming exit liquidity for someone bigger. And if you're the kind of viewer who's here because you're tired of being fed narratives, if you want mechanisms, not slogans, then you already know what to do. You watch the level, you watch the close, you watch the behavior on the first serious pullback, you watch the currency backdrop, You respect the calendar, and you don't let one violent candle bully you into abandoning your process. Stick with people who think that way. Build a community of mechanism watchers, not headline chasers. Because in markets like this, your edge isn't having the perfect prediction. Your edge is staying rational while everyone else gets emotionally harvested. This week, gold will either prove it can hold the new floor and turn the $5,000 shelf into history, or it will snap back hard enough to remind everyone that leverage always gets paid for, one way or another. Watch the behavior, not the noise. And remember, even if the big thesis is right, the path can still be violent and volatility will be used against you. Don't give it that power.